Hey everyone, welcome back. We are now looking. So last time we actually talked about how to travel from a honeymoon standpoint, international travel, and great information. If you haven't had a chance to listen to that, please go back and listen and watch, especially if you're about to get married. There's some really great information in there. But this time we're actually going to talk like some details about things that people rather not talk about or they just are afraid to talk about. We're talking about home mortgages, and that's a kind of a big, scary word. But because a lot of people probably think, "Oh gosh, I've only had one mortgage in my life. I want to go through that process again." So, but I'm here to help. So we have today Andy Gagliano with Gagliano Mortgage, and he has been in the mortgage business for quite a while. He knows all the ins and outs, and he is fantastic to work with. We've been working with him as a company for a couple of months now, and just absolutely love Andy to death. And so I want to take an opportunity to bring him on and kind of let him talk about what he does, and hopefully answer some questions that people probably have about the mortgage world that they're afraid to ask. So Andy, tell us a little bit about yourself.
Well, first of all, thanks for having me, Michael. I appreciate the opportunity to come on and share something I know a little bit about. You said you were going to pick on my expertise, and I don't know that I have a whole lot of it to offer, but we'll try it and see what we've got. And, I'm glad that you transitioned into mortgage from marriage and honeymoon, because I didn't want to have to turn you down on this, on your proposal right here on this podcast. That'd have been terrible.
I love it.
But, and I say that I might be playing hard to get, but anyway. So I have been in the mortgage business for about 27 years now. Okay. And I started my company 25 years ago. So March this past year, 2020, was 25 years that I celebrated since the creation of Gagliano Mortgage. And, it's been a wild ride, a lot of good years, a handful of bad years in the industry following the crash in 2008 and, all those hard times. And now we're, in the midst of a pandemic, and a lot of people are struggling right now. But, for people who can buy right now or can refinance right now, and usually the number one limiting factor of that is if they're employed or not, it is an excellent time to either refinance or buy, because mortgage rates are at all-time lows. And so, that presents a great opportunity for people to get out there and either save some money on their current mortgage or possibly pull some cash out of the equity that they have in their property, because property values have escalated so much over the past several years, or jump out there and buy that dream home, and it's just a great time, because right now, even though property values have been escalating, they have been escalating enough to make the real estate market attractive, because mortgage rates have come down. And so someone who may have to go spend, let's use a nice round number, $300,000 on a house, can get that $300,000 house today for the same payment that they could have gotten a $250,000 home a year ago. And so, it's a really great time to be out there and in the market to buy or refinance.
Oh, yeah. So touching a little bit on, you've been in this industry now for 27 years. So you've seen, like, you were heavily involved in 2008, like you were.
Yeah.
And most people who are watching this definitely remember that. And that was a time in this country, at least, that was detrimental in your industry, really most industries at that point. Yeah. Was there, just trying to think here, like, if you've seen that, and then here we are, last year was an incredible year, and then this year things got turned on its head.
Yeah.
The pandemic. I think from your standpoint, looking at this, knowing that you've been through 2008, I mean, what we're seeing here in 2020, is it bring memories back from 2008, or do you think we're way beyond what 2008 was even trying?
That is a fantastic question, and it's one that I've had a few people ask me, and I do not see a lot of similarities between where we are right now and 2008. And the main reason that I say that is, in 2008, there was an unbelievable amount of speculation going on in the real estate world.
Mm-hmm.
There is some of that going on right now. And, I think a lot of the factors that are driving the speculation in real estate right now are TV driven. Yep. Because everyone's at home watching a lot of TV, and one of the most popular channels out there right now is HGTV, and they've got all these flipping shows on there, and they make it seem like it's so easy just to go out and buy a house that needs a little bit of work done to it, fix it up, flip it, and make this huge profit. And in all actuality, it's not that easy. And so these people who have these shows are getting these houses from certain leads within the industry before those properties ever hit the market.
Yeah.
And so average buyers like you and me don't have the opportunity to get out there and purchase these homes at these discounted prices like these flippers and these people that have these shows are doing. But that's a little off topic. Getting back on topic, so I'm probably going to say some things, and you know me well enough personally to know that I'm not very politically correct. I'm just going to say stuff and we'll deal with it, but you have to know my heart's in the right place. My words don't always sum up what my heart feels. And so if what I'm about to say seems cold, it's not meant that way. I know there are a lot of people who are suffering from this pandemic, and financially and even physically. And so another major difference that I see in today's market and the market in 2008 is that the majority of people who have been hit the hardest by the pandemic, with the shutdowns in the business and so on and so forth, are in the service industry, food service, travel and leisure. Those types of industries have been hit the hardest. And those industries typically are not the industries that put out a bunch of home buyers. And so, I'm probably am going to beat this horse until it is absolutely dead and there's nothing left of it. But, you look at your average waiter or your average waitress, they're not of home buying age. Now, granted, legally, you can, in the state of Alabama, you can buy at the age of 19. But what I mean is they're just not, they don't make up the big demographic of home buyers.
Yeah, I mean, they're your renters. They're renting apartments and maybe renting a home or maybe staying at home with their family. I mean, because even from, and that will get into our first question in just a second. But your minimum wage to really anything under $20 an hour, it's difficult to buy a home. Mm-hmm. There's ways to do it, obviously, but just from the standpoint of someone would much rather pay at that wage as a $600 or $700 a month rent than a 15 or 30-year mortgage. That's probably gonna be more per month.
Right.
And so, I totally get it. And I think you're right. I think what's happening right now had a huge impact on the service industry. I mean, like you said, the restaurants in particular, and that's a demographic that generally may not be buying a home right now. They're looking to the next level, and then they'll get there, and then they'll look at buying a home, but just not right now.
Yeah. And that the renters and them not being able to make their payments does affect the real estate market in the respect that there is a property owner out there who owns that property, who likely has a mortgage on it that renter is in, who is not paying the rent.
Yep.
And so that is going to lead to some foreclosures and that type of thing. And, somewhere down the line, we could see some depreciation in the real estate prices. But now is just such a good time because interest rates are so low that, you still have to look at it and say, okay, if I buy this house for $300,000 today and I get an interest rate in the upper 2s, lower 3% range, and the price of the house depreciates by 10% or 15% over the next 2 years, if you're not planning on moving in 2 years, what does it matter? You're in this house and you're a lot better off than you would be paying today's escalated rent prices.
Yeah, I remember in 2008, because I would say like one of the biggest differences between 2008 and now is that you can still put your house, if it's a good house, you can put your house up for sale and sell in a day. In this market. In the Birmingham market, like my brother recently sold his house in Trustful. It was on the market for a day or two, and it sold. And he had more than one offer coming toward it. So it's kind of like you go back to 2008, his house would be still for sale right now.
Oh yeah, no doubt.
It would not. People weren't buying. And then going to what you're saying, if you don't plan on moving for a long time, well, don't worry so much about the value of your home right now. Don't get, because I remember remember talking to somebody, they said, yeah, I was really nervous in 2009 about my house. And we're like, but I'm not going there for 15 years. Like, well, who cares? Keep making your payments.
Yeah.
And then just when that time comes, you do sell, you'll probably end up making money just over time because as we all know with investments in general, it's the time in the market, not timing the market.
That's right.
And so anyway, yeah, I think that's good. But all that being said, I think that it's a good transition to our first major question here is help the first time home buyer understand what their expectations are, what are the best practices, basically, if you were going to give somebody a simple guide to like, hey, if you're a first time home buyer, look at this, this, and this, and it'll make it better for you. Or let me explain like why this is going to happen. Don't be caught off guard by this. So from your expertise, because I've only owned one home. I've only gone through the mortgage process one time.
Yeah.
And I know it was like it's like the first time you buy a car. It's the first time you do these large things in life, these life-changing things, and it's all scary. And then once you're done with it, you're like, oh, well, that's not too bad. And then of course we all learn something from it. Like I learned with my house, it was a foreclosure and it was VA owned, which I learned that being a VA owned foreclosure is actually not a terrible thing because the house was in perfect shape and not messed up. And it was actually winterized and everything. But then the problem that we ran into was the VA demanded an exact final price, and there was something on the price, like something depreciation every day on something, and it changed it like by 20 or 30 cents a day. And we had to go back to the table like 4 times to get it finalized. It was frustrating, but it went from like, oh, I'm closing today, 3 closings later, I finally closed because it was just literally, I remember the closing attorney just said, hey, I got 75 cents in my pocket. I can just hand it to him.
Right.
So, I mean, that's how hard cut it was. But no, so tell everybody that's watching, like what to look for, calm their nerves type of thing.
Yeah. So, the first thing I would say to a first-time home buyer, and in fact, I do say to every single first-time home buyer that calls me, is use a real estate professional to help you find the house that you want to buy and to walk you through the home buying process. Because as a buyer, you're not paying that professional's commission. The seller is paying the commission to that professional who's helping you to buy that person's house. So, I mean, that's like, getting all the expertise of someone, and I mean, you're just getting it for free. So why would you not take advantage of that?
Yep.
And real estate agents have access to thousands of properties for sale in their database. And so they can help you once you tell them what it is that you're looking for. They can help you find the perfect property and then start to walk you through the process of how you become a buyer. So that's the first thing that I would recommend to any home buyer out there, especially first-time home buyers. So secondly is just to kind of piggyback onto what you said, it's important to remember that you're not the first one to go through this. And
there's a process.
There's a process. And the process is, it can be frustrating at times. And it can be an emotional anchor at times. But what I would say is that once that transaction is closed and done and you've moved into the house, every day that goes by become that struggle that you went through to get the house closed, and all the ups and downs that you went through emotionally to get the house closed, and the expense of buying the house just all goes away. Mm-hmm. And you realize in 5 or 10 or 15 years when you get ready to sell the property that it was all way worth it, because had you continued to rent, you wouldn't be getting that big fat check when you sit down to sell the property, and you wouldn't be getting the equity in the property that you built back up out for you to go buy another one. Or, if you're retiring, you go retire and you use that money for whatever you want to use it for. But that's kind of the 100,000 foot view. We'll get in a little bit closer as someone's going through the mortgage process as a first-time buyer. I would say that the majority of the issues that I see come up on a mortgage application are income related and or asset related. So, there's certain, I guess, commandments of getting a mortgage that applicants do not need to break. And, one of those is, when you apply for a loan, when you apply for a mortgage, don't apply for any other debt. Do not buy anything. Sometimes it happens and your vehicle breaks down and it's beyond repair. So what do you have to do? You have to be able to get to work. You have to be able to go here or go there. You have to go buy a car. Before you go buy that car, you need to call your mortgage professional and talk to him or her and just say, hey, I've got to do this. I have no other choice. I cannot wait. I don't have a car that I can borrow from my parents. I don't have a car I can borrow from a friend. I have to go get a vehicle. So, the first thing I would say is don't take out any new debt at all. But if you have to, consult with your mortgage loan originator first. Second thing I would say is regarding assets, regarding the money in your checking account. You cannot just move money from one account to another without showing where that money came from. You can't just get a loan or a gift from a family member and put that into your account without proving where it came from. The reason that the mortgage industry is so concerned about assets and where those assets came from is that we have to prove that an interested party in the transaction did not give those funds to the buyer. Meaning, we've got to prove that your loan originator didn't give the buyer $1,000 to make the transaction close so that the loan originator could get a paycheck of $4,000 or $5,000.
That's pretty. That didn't even cross my mind, but that makes total sense. It prevents fraud.
It does.
Okay.
It does. And so we have to really dig in and we look at assets. I mean, we really go through them with a fine-tooth comb. And so something to keep in mind for the viewers out there and the listeners out there is regarding assets. Typically, we are going to question any deposit into any asset account that you provide us the bank statements for. We're going to look at any deposit that goes in there that is greater than 50% of your gross monthly income.
Yeah, okay.
So if someone's making $5,000 a month and they get an income tax refund check of $3,000, that's 60% of their gross monthly income. So we've got to prove where that $3,000 came from, and we do that with a copy of the tax returns showing that the $3,000 deposit into the account matches the refund from the tax return of $3,000. It matches penny to penny, and we're good to go. So those are the type of things that usually present the most issues with home buyers, and those are things to be really careful of and cognizant of as you prepare to go into the process. Yeah. It's much easier if you've got all your ducks in a row before you start the process than it is to try to get your ducks in a row after you've started the process.
Yeah, and that will go into our last question about what are those ducks and making sure we're all, if you were going to give somebody a one-sheeter, like, if you can do all this, you're going to have the best mortgage experience ever.
Yeah.
So we'll get into that in just a second. But that's really great to hear. I like the no new debt. I've heard about the no new debt thing. Like when you're applying for a mortgage, just don't do things stupid and just keep work. Just work. Do your normal thing. Don't
hold off on the Rolls Royce.
Yeah. Don't buy that bass boat that's been calling your name. Don't go buy that new side by side that you really shouldn't buy.
Yeah.
Which is really comical to me. I didn't, because like I have a four-wheeler and I bought my four-wheeler like in 2009. It's a Honda Rancher, and I did not realize how expensive those things have become over time. Like I think I paid $4,500 or $4,200. No, it was cheaper. $3,800 brand new. And I went back and looked at them this year because I was just curious. A brand new version of what I have is like almost $7,000, and it doesn't make sense to me. But that's such an easy, like, oh, I can just buy that. It's only going to cost me $200 a month.
Right.
And don't think about it.
Yeah. And that $200, that could or could not be an issue.
Yeah.
But I've had situations where it's come up where it's been an issue, and all of a sudden somebody has a nice, new, pretty four-wheeler and no house or garage to put it in.
Yeah, I could see somebody trying to buy a house on the lake or something. It's like, oh, I need a new boat or whatever to go with. And they go to the Bass Pro or something, and they just say, oh, I got to have it. I'm getting a house next week anyway. And then all of a sudden they don't have a house to put the boat in.
Yeah. And, buyers a lot of times think, okay, well, I'm closing on my house today. So, the seller's taking the refrigerator and I have to have a refrigerator. So if I'm closing on my house today, I'll go buy this refrigerator today. No one will know.
Wow.
We will know. We pull credit the day of closing again. And so when we see an inquiry from Best Buy or, the local appliance shop into your credit because you've applied for a new card for 0% financing for 12 months or 24 months or whatever it is.
That one question said, would you like to apply for a card day? Yes.
No, you don't. Or maybe, yes, you would like to, but no, I'm not going to.
Oh,
it's
man.
Okay to put that refrigerator on your own credit card that you already have. We're not going to verify your balances on your credit card accounts the day of closing. But do not open any new credit at all until you've got the keys in your hand and you have unlocked the door to the front
Nice.
door of the house. Yeah.
Nice. Yeah. Okay. Good to know. That's actually really, I could definitely see somebody saying, hey, we're at the closing day. I'm going to Lowe's afterwards to pick up that fridge or whatever. Or no, I went this morning, went and picked one out, and then you're sitting at the closing table and like, hey, what's this?
Yeah. I'll share a story with you real quick, and you know, this has been, goodness, I don't think I was in the mortgage business, but maybe 3 years, maybe 4 years when this happened. So it's been a long time ago, and I can laugh about it today, but it was cry worthy the day that it happened. So I had a young couple, newly married, buying their first home as clients, and it is the day of closing. They were putting a very low down payment on the house, 3% down, and the seller was paying all of their closing cost. They had, I mean, almost to the penny, they had just barely enough money to put their down payment on the house and buy it. We didn't have any additional funds verified on this loan. The day of closing, they went out because I told them don't open any new credit. The day of closing, they go out and they buy a refrigerator and pay cash.
Uh-oh.
So now where's the down payment money coming from?
Oh, gosh.
They don't have it. They spent their cash that they had in their account that they were going to use as down payment on the house, not all of it, but a big chunk of it to go buy a refrigerator to put into the house that now they cannot buy.
Wow. Wow.
I mean, things like that, you think, surely I shouldn't have to tell you.
Yeah.
You have $3,500 in cash. Don't spend, a large portion of it on anything before the closing. You have $3,500. You need $3,400 to buy the house. Don't go spend a whole lot of money on anything.
Wow.
But they did.
That's crazy. Man, I can see it happening though. Like that, it's such a simple. Okay, well, good to know. It's kind of sad, but good to know. All right, so moving forward, so we talked about the first-time buyers. Now let's talk about the refinance people, where they've had a mortgage for a while, and just like me and everybody else, all I hear nowadays is historically low rates. And what does that mean? And what's a good when should I truly be interested in doing it? That type of thing.
Yeah. So historically low rates, what does it mean? Well, we've been, as a nation, have been tracking interest rates for about 60, 70 years, somewhere in that ballpark.
Yeah.
And we are right now at a point to where interest rates on mortgages have never been this low before. The difference between an APR and an interest rate, because it's something that comes up so often in the mortgage process because it's very confusing. The best way I know to sum it up is to say that the APR is supposed to be someone's true cost of borrowing money, meaning interest rate and closing costs that are associated with getting that loan. And the interest rate is the true cost of the money itself. How much are you going to repay on that loan that you're getting over the period of time that you have the loan out, over the loan term? And so that's the big difference. Generally, the APR is higher than the interest rate because it includes closing costs associated with that loan. And so that's just a little aside. It comes up all the time because we're required by law to disclose the APR, the annual percentage rate. And of course, we're required by law to disclose the interest rate. And so those two things come up. They rarely ever match. And that leads to the question of, hey, Andy, I thought you said my interest rate was X, but this APR says my rate is X plus whatever percent. And so that's the difference in those numbers. But with interest rates as low as they are right now, I mean, it is amazing to see what some of my clients have been saving on their mortgage payment wise each month when they've only had their loan outstanding for a year, 2 years, or 3 years.
Wow. Okay.
Typically, just as a good rule of thumb, it makes sense to refinance if you can save about 1% off of your current interest rate. Now, there are a lot of variables and a lot of factors that can change that. One of them being the length of time that someone expects to keep that mortgage or to still live in the house that they're living in. So if someone tells me, hey, Andy, I'd like to refinance, I'm at 4.25% right now on my current mortgage. I owe, $250,000 on it. And, I want to do a 30-year fixed rate and just see how much money I can save on my payment. Well, one of the questions that I'm going to ask them as I'm going through this qualification session with them, because really I'm qualifying them not only to see if they qualify for the loan, but see if the loan qualifies for them. Yep. Because one of the questions I'm going to ask is, well, how long do you plan on staying in the house? And if they say to me, well, we're thinking about moving in a year or 2 years. Well, I'm not going to say, no, don't refinance, because they could benefit from a refinance, but they're going to benefit less from it than someone who's going to live in the house for 5 years, 10 years, 15 years, who can have then 5, 10, or 15 years of that monthly savings to put into their pocket. This client is only going to have a year or 2 years worth of savings to put into their pocket. So that person who tells me, hey, I may only be in this house for another year or 2 years, I'm going to start talking to that client about let's get away from what I like to call the Christmas party talk. The Christmas party talk is when someone corners you and says, wow, these interest rates today, and it amazes me, the people that don't even know I'm in the mortgage business start talking about interest rates and real estate. But fantastic. It happens, and they say, I hear people say all the time, well, I got, 2.1% on my loan and blah, blah, blah. And, I'm sitting here thinking, well, that's all fine and dandy, but what did you pay in costs to get that rate? Because there's a balance there. The lowest interest rate is going to come with higher closing costs. Mm. A higher interest rate is going to come with lower closing costs. So someone who tells me, hey, I think I'm only going to be in the house for a couple of years, there may still be an opportunity for them to save money each month by refinancing, but let's talk about a little bit higher interest rate and lower closing costs so that you're not spending $5,000 in closing cost to save $100 a month on your payment. Yeah. Well, do the math there. If you're saving $100 a month and you're going to live in the house for 2 years, you've only saved $2,400, but you spent $5,000.
I wonder, I could see people having this misconception that they can refinance and it doesn't cost them anything.
Oh, yeah.
Because I could imagine like people are like, oh, I can just, because in their head they're like, oh, you make your money off the interest. Like, no, the people who are actually doing the loan for you, they're not. There's a process. There's a lot of things that go into play because essentially you're buying your house again per se. Yeah. You got to go through the whole process there. And you're right. If you look at closing costs and it's like $5,000 to close on a refinance, and then you're saving and payment $100 a month. Well, that means it takes 5 years for it to make a lot of sense. And right. If you're like you're saying, if you don't think you're going to be in that house for the next 5 years, save your money for now, and then reap the benefits at a later date when you're looking at the new house you're trying to get. Mm-hmm. That makes total sense. I didn't even cross my mind that the closing costs would negate the savings if you're there for the short term. but
Yeah.
it makes total sense there. Very good. I like that. I think some people, it's such a simple thing. Like so far, and this what I've learned is that these things are very simple, but people sometimes just don't think.
There's a lot of that. And there is a lot to this whole entire process. But it's important to work with someone and look, I'm going to say this again. You're not getting politically correct out of me. I will never say something negative about my competition.
Sure.
That's just not going to happen, period. Because everyone's experience in the mortgage process is different because everyone is different. Their qualifications are all different. So what I am going to say, though, is I don't care where in the country you live. I personally feel like it's important to work with someone in the mortgage industry and the real estate industry who is local. And, I'm not saying anything negative about my competition. The reason I feel like that's important is because I think it's important that you have the ability to walk into someone's office and kick them in the shin if they do something wrong or if they don't shoot you straight. And for someone who wants to go and refinance their mortgage or buy a home, if they're working with someone local and they can go and they can sit down face to face with that person. Look, I'm a very visual learner. I have to see things in black and white a lot of times for them to make sense to me. And if I can sit down face to face with someone and go through those documents and those numbers in black and white and have someone explain things to me, then it's so much easier for me to understand what's actually going on. Yeah. So that for me is why I think one of the reasons why I think using someone local is so important. It doesn't necessarily have to be Gagliano Mortgage, but someone local is important if you're in the Birmingham area. And so being able to sit down with someone and just go through those scenarios with them and say, hey, here's option one. Closing cost, $5,000, saving $100 a month. But let's look at option number two, which is closing cost at $2,500 and we're saving you $75 a month. Now your break-even period's a lot more in line than, where we were at 50 months, before at $100 a month savings and $5,000 in closing cost. Well, now you're somewhere in the neighborhood of 40 months, 35 months. Math's not my strong point, even though I'm in the mortgage business. Just kidding.
Calculators, right? Lots of calculators.
Calculators will spoil you. There is no doubt. There is no doubt. But, it's just good to have a professional that you can work with, that you can sit down with and go through this stuff and ask questions until you're comfortable that you are getting the best deal that you can get.
Yeah. Well, and I would say even from our standpoint, I know you're in the same boat of our interests. Like when I go to talk to somebody about digital marketing, our interest is I want to make sure that it is benefiting you, the client or the potential client, and not just benefiting me.
Right.
We talk about in our core values about having a win-win partnership. Our goal, is everybody's winning. And so same with you. When you're sitting down with somebody who's looking to do their first time mortgage or a refinance or whatever, you're making sure that they're not going to hurt themselves down the road. Mm-hmm. Even though you can make a quick buck, but you have enough concern in your heart to say this is not going to be good for them in 2 years, and they don't see that, and I have to open their eyes to see that.
Right.
And I think that's a big difference too, because when you're local, you may run into that person at the whatever store, and you have to have a clear conscience about it, right? So, so that's the other factor in being local, doing somebody local, is that you probably shop at the same stores or drive the same roads and sit in the same traffic. So there's an extra layer there. You can't hide per se.
Yeah.
But anyway, so I know this is getting the recording's a little long today, but let's take the last 2 or 3 minutes. And if you were going to give somebody hey, if you do this, this will make everything a lot better. What are the things that you were looking for? Like the first thing, okay, I need this, this, and this to even start fully discussing. What are those things that people can have ready? So if I had these things in order and I call you up, you say, well, great, you're ahead of the game. What are those things?
Yeah. So no matter if you're wanting to refinance or buy, if you can have 2 years tax returns, personal tax returns ready, that would be huge. If someone's self-employed and their company is incorporated as an LLC or an S Corp or a C Corp, then we need 1 to 2 years worth of business tax returns. So I would just go ahead and say 2 years personal tax returns, 2 years business tax returns, and that person should be ready no matter what. If they're a W-2 employee, then typically we'll need 1 month's worth of pay stubs, and the pay stubs have to show the employer's name, the borrower's name, and it has to show a year-to-date earnings and deductions and so on and so forth down that line.
So a real pay stub.
A real pay stub. Exactly. Yes. The handwritten pay stubs on, from a checkbook from your employer typically are not going to cut it. So
and then going to what you said at the beginning, you better pay your taxes.
I could tell you some stories, Michael.
Man, I have seen. I've literally talked to people, and they're like, "Oh, I haven't filed a tax return in like 4 years." I'm like, "Well, good luck, because it will catch up to you."
It will. It definitely will. Yeah, that's a different podcast in and of itself for sure. So that generally will satisfy any income requirements. Those things. So as far as assets are concerned, if someone is pulling cash out of their residence, we typically don't need any bank statements or to prove any assets, because we're giving them money to close the transaction. They're not giving us money to close the transaction.
Gotcha.
So if you're giving us money to close the transaction, then what we need typically is 2 months worth of bank statements. Now, something on the bank statements to kind of keep in mind is that the bank statements need to show the bank's name, your account number, and it needs to be, if you can provide a copy of the bank statement that the bank sends you or allows for you to access electronically every single month, then that's ideal. That will have everything on it that we need.
Okay, cool.
But if you can't, and you have to go online and do an account history printout, then those things have to show up. Your name, bank name, the length or period of history that your mortgage originator has asked for, and you need to have a running balance on that history. It cannot just show a transaction and not show the balance in the account after that specific transaction. So it's got to show those things. The date range is very important so that we can prove, okay, yes, this is a 30-day history, or this is a 60-day history, whatever it is that we require.
Basically, you're just giving evidence to what you've been told, or you're
Correct.
telling your mortgage person, like, hey, I make $5,000
exactly
a month and I don't have enough. My debt's low enough where I have money left over. Okay, prove it. Okay, here's my bank statements.
Yeah. Yeah. And then for someone who's buying a house, we need a sales contract. The sales contract needs to be fully executed. Oh, one thing I want to take a step back and just hit with the bank statements again very quickly. At the top of your bank statement, 95% of the bank statements I see have this on there. It will say 1 of 2 or 3 or 10 or 20 pages. I have to have every single page. Even if page 20 of 20 is blank, at the top of page 20 of 20, it says page 20 of 20, and there will be nothing on it. I still have to have it. You don't give me all pages, the underwriter thinks that you're trying to hide something. So keep that in mind. But a sales contract. So for those people buying a home, a sales contract is very important, and it needs to be fully executed. So we need to have signatures from the buyers and the sellers on it. And, all of the blanks need to be completed. All of the areas that need to be initialed, and so on and so forth. So that's very important as well. And then there's going to be things that we're going to discover after someone provides us with those documents. There's going to be things that we discover that we need as well. So, there will be a secondary list of documentation that someone will need to bring. And one other thing someone can have together is a photo ID. So a driver's license, something like that, that's legible. We need to be able to read all of these documents.
Nothing smudged out,
Nothing redacted, nothing blurry. If you take a picture of your driver's license or a bank statement and email that, it must be legible. So just, things that are very important that those are common issues that we have to go back to clients for. So.
Oh, well, I mean, it sounds like a lot, but at the same time, it's something that if you're a responsible person that understands what's being asked for, you could probably collect almost all that info in a day or two if you needed to. Probably wouldn't take much.
I have more clients today who have all of those documents imaged and either on a thumb drive or on Google Drive or Dropbox or someplace like that. And I ask them, hey, send me 2 months bank statements. And it's 5 minutes later that I've got 2 months bank statements.
Nice. Yeah. So, I mean, everything is like self-serve too. Like I can go onto my online banking right now, pick out dates, hit download, and I got it.
Yeah.
And then like you said, I scan all of my tax returns, everything's digitized. So phone and download and send, like it's just to that point. But it's still good to know, because I think there are some things in here that people may not think about when they're like, oh, I got all this. And they're like, oh, wait, no, I don't. And then think about that. Or they may have an oh crap moment and say, yeah, you shouldn't look at last month's statement. Look at the months before. That one looks a little better.
We hear some of that too.
Like I get that too, because when I got my mortgage, I was a sales commission only place, and like the month before did not look great. When you looked at the other months, it was fantastic. I just had like one off month, and it was kind of funny.
Perfect timing, huh?
Always. But all right, so that concludes everything here. Thank you, Andy, for taking the time out to talk to us. This is really great info. Actually, really, I even though I've been through the mortgage process, I still learn from this. I mean, especially the refrigerator thing, that cracks me up. I feel bad for those people who have done that.
It was a rough day. Yeah.
So, but good to know all together. So thanks again, Andy, for doing that. We'll have a link to your website in the description. So if you guys want to reach out to Andy about your mortgage or refinance or anything like that, he's your guy. He will take care of you. He's located in the Birmingham area. So if you're in the Birmingham area, y'all can actually meet in person and not just over a phone. So, all right. Well, thanks again, Andy, and we'll catch you on the next one.
That sounds great. Thank you, Michael. Have a great day.
Thank you.
All right.